To give us more insight into this fundamental is a macroeconomic strategist, Abdulaziz Kuranga. Good morning, Mr. Kuranga. A pleasure having you join us on the program.
Good morning, and thanks for having me.
Let's dive into our conversation now. I asked two of my guests earlier on the show, that's Charles and also Ambrose, this question. I'm throwing the same question at you. We are expecting resolutions of the meeting tomorrow, but then again, let's do some projection. What is your expectation of the outcome of the meeting? Do you see a retention, an adjustment, or a hike in the price, in the monetary policy rate of the MPC?
Okay, all right, thanks once again. You know, this meeting is being chaired by another civilian governor, and is also the first after the first for a new administration, and also is also coming at a time where the new administration has promised some house cleaning and also promised some reforms, some of which we've currently been seeing. So this meeting will somehow be crucial in terms of setting the tone for monetary policy decisions over the next 1 year. So we think at this meeting, and the main focus of this meeting will be on trying to address concerns concerning FX and also monetary policy tone. So we think the Monetary Policy Committee will likely hold key policy parameters constant. And one factor for shaping these expectations is that despite the 200 bips interest rate increases that we've seen over the past 5 months and in the first 3 meetings of the year, we've not seen that translate into increases in short-term market interest rates. So we think that concern needs to first of all be addressed before we should be talking about further interest rate increases. So we need to first of all address those concerns concerning the transmission between monetary policy rate increases and short-term interest rates. So that is likely going to be one of the burning issues at this meeting. So we'll be looking forward to how the current CBN will try to address that situation. So as a result of that, we think holding now will be an optimal decision, while they try to look at how they are going to increase the transmission mechanism from increases in interest rates to market interest rates. Because since these are not even reflecting on market interest rates, it means that further increases in the interest rates will likely be filtering through and constraining activities in the real sector of the economy, thereby significantly impacting growth. And also remember that growth for now, even without further interest rate increases, growth rates for now, short-term growth rates for now is being tilted to the downside risk, particularly how we've seen PMS subsidy removal and FX unification impacting consumption in a negative way. And given that household consumption expenditure is about 60 to 70% of the economy, so it means that growth is likely to slow in the near term. So further increasing the interest rates at a time when we've not even seen the impact of previous increases on market interest rates. If you are further increasing the interest rate, then you are definitely constraining the real sector. So we think holding for now would be an optimal choice. We are trying to look at how you are going to significantly improve market interest rates in line with the past interest rate increases that we've seen. If not, any interest rate increases will just be like what we've seen before, which are just symbolic in nature and not really affecting our market interest rates. Moreover, going into the global space, we've seen global central banks also trying to slow down their interest rate increases. And for now, consensus expectations for the US Fed is that after they increase by 25 basis points at their July policy meeting on Wednesday, we are likely to see the US Fed maintaining a hold stance over the rest of the year. Same expectation is also playing out for the European Central Bank as well as Bank of England. And also, we've also seen South Africa Reserve Bank also holding key policy rates last week, and the expectation is that by the end of today, Ghana should also be doing the same. So And we've seen over the past 1 year that these global central banks, they tend to be moving in the same direction, even as inflationary pressures persisted in the global space. So we think that will also be influencing decisions also. So overall, we are tilting towards the Monetary Policy Committee holding key policy rates constant at the end of their meeting tomorrow.
Abdulaziz, now I want to throw this question to you now. Some analysts have said that the current level of hardship, which is obviously induced by the current inflationary pressure and the hike in the price of fuel, is putting pressure on the MPC to come up with an interest rate regime that will ease the tension in the economy. What other measure can the MPC come up with in managing or taming inflation without hiking interest rates?
Okay, thanks for that. So first of all, we should, as we are talking about what the monetary authorities should be doing, and we should also be putting more pressure on what the fiscal authorities should also be doing, because this is this inflation fight is not a one-man fight, as we've seen over the past 8 years. So it's a combination of what the fiscal authorities should be doing and what the monetary authorities should be doing. So for now, going by the factors that we've seen that are significantly leading to increases in prices, so we think more needs to be done from the fiscal authorities rather than the monetary authorities, because interest rate increases can only address the monetary side that is affecting inflation. So they can only address the demand side factors affecting inflationary pressure. So however, for the supply side factors, those are majorly the core function of the fiscal authorities, that is the government. And what are these factors that we are looking at? And we are seeing issues particularly for food, and we are seeing issues concerning flooding issues, and there are still concerns surrounding that flooding for 2023. Also security challenges, and we're also seeing infrastructure issues. So all this still needs to be addressed by the fiscal authorities. If food prices are able to go down significantly, if we're able to address the supply side factors significantly hampering food prices, inflationary pressures should be moderating. And what is even more interesting with all we've been seeing concerning the FX issues as well as transport issues is that over time, these things, they tend to be disinflationary in nature, because by the time prices eventually stabilize, then by this time next year or by the second half of next year, we should be seeing inflationary pressures drop significantly from all these current issues that we are seeing, from fuel prices, FX issues. So by next year, so we should be seeing a favorable base from this year to be significantly leading to significant moderation in inflationary pressures next year. But for food prices to now moderate over time, then we think majority of the things that needs to be done rest on the fiscal side rather than the monetary side. So the federal government needs to do more and ease the burden from the central bank's perspective, because even as at now, if we are seeing calls for interest rate reduction for now to maybe ease some things or maybe improve investment and the likes, and those things they are, in our view, they are not tenable for now, given that they will be going against principles, because when your inflation rate is increasing, either you try to hold your policy rate or you increase, and those are the decisions. But you now reducing is going against what is happening, and that will further be widening the negative real interest rate gap. And what we tend to see in such cases is that investment outflows will be increasing significantly, and your domestic, your citizens will not have the urge to want to hold naira assets. So in that case, you will be seeing persistent depreciation in the local currency, which is not what we want to see. So reducing interest rates, in our view, is not an option for now. Rather, you either hold or you increase, while the rest of the measures to sort of ease the current hardship and rest on the federal government in trying to address the supply side factors affecting food prices and overall headline inflation.